Rather than abandoning his risk management principles during these episodes, he adapted them with remarkable ingenuity. For gap openings, where price jumped significantly above or below the previous close, Livermore recognized the danger of conventional market orders. If you place a market order after a large gap, you're essentially surrendering control over your execution. Price potentially leading to slippage far beyond your intended risk threshold. The revelation in Livermore's approach was his use of what we might now call mental stops during these volatile periods. Instead of automatically selling at market price when a gap occurred, he would wait for a potential retracement while maintaining an absolute limit on his maximum acceptable loss.
You like to eat healthy and save money, and let me put you on these beef sticks. This is the Paleo Valley 100% grass-fed beef sticks. They're gluten-free, soy-free, dairy-free.
This balanced approach allowed him to potentially exit at more favorable prices while still honoring the core principle of defined risk. The key insight was that while the specific technique might adjust to market conditions, the fundamental commitment to capital preservation never wavered. This adaptive mindset represents a crucial milestone on the journey toward trading mastery. Rather than rigidly following a single approach regardless of context, Livermore developed the wisdom to adjust his tactics while maintaining his strategic principles. It's a profound lesson in how flexibility and discipline can coexist within a coherent methodology. While markets have evolved dramatically since Livermore's era, his core principles remain astonishingly relevant for today's traders. The technological landscape has transformed. We now have access to sophisticated platforms, automated order types, and algorithmic execution that would have seemed like science fiction in Livermore's time. Yet, the underlying market dynamics and human psychology remain fundamentally unchanged. Modern traders can implement Livermore's methodologies with unprecedented precision. Automated trading stops can execute his fourth rule with perfect discipline, removing the emotional challenges of manual adjustment. Algorithm-based scans can identify pivot points and volume anomalies across thousands of instruments simultaneously, expanding the reach of his analytical framework beyond what any individual could monitor manually. Yet amid these technological advances, the essence of Livermore's approach remains unchanged. Understanding market structure and maintaining unwavering discipline. The tools may have evolved, but the fundamental principles, the recognition of support and resistance, the importance of volume confirmation, the psychological discipline to follow predefined rules, retain their transformative power. Perhaps the most profound legacy of Livermore's methodology is this timeless quality. In an industry obsessed with novelty, where trading systems often shine briefly before fading into obsolescence, Livermore's principles have endured for nearly a century. They transcend specific market conditions or instrument types because they're rooted in the unchanging realities of market behavior and human psychology. Let's explore how you can develop your own personalized stop-loss framework based on these enduring principles. If you're finding value in applying these century-old wisdom to today's markets, type timeless principles in the comments below. Understanding Livermore's methodology is only the first step on your path to trading transformation. The true challenge and opportunity lies in developing your own personalized stop-loss framework inspired by his timeless principles. This isn't about blindly copying techniques from a century ago. It's about extracting the essence of his wisdom and adapting it to your unique trading personality. Begin by honestly assessing which of Livermore's 5 rules most naturally align with your trading style and time frame. Are you a technical trader who can easily identify pivot points for stop placement? Are you patient enough to implement time-based stops without emotional interference? Do you have the discipline to never average down on losing positions? This self-reflection is crucial. Even the most brilliant methodology fails if it conflicts with your authentic trading personality. Once you've identified your natural alignment, create a systematic implementation plan. The revolutionary approach that separated Livermore from his contemporaries was his commitment to documenting his stop-loss plan for each trade before entry. This pre-commitment strategy bypasses the psychological traps that ensnare most traders during the heat of market action. When emotions run high as prices move against you, having a predetermined exit strategy becomes your psychological anchor. The hidden truth behind trading mastery lies not in finding the perfect strategy, but in consistent execution and refinement. After each trade, document not just the financial outcome, but your adherence to your stop-loss rules. Were you tempted to move stops further away? Did you honor your time-based exits even when your conviction remained strong? This honest self-assessment creates a feedback loop that gradually refines both your methodology and your psychological discipline.
Năm 2026, Activa có một chương trình bảo hiểm với tổng phúc lợi lên đến 2.880 đô la mỗi năm cho tiền đi chợ và thuốc hồi kê toa. Tiền không dùng hết trong tháng được để dành qua tháng sau. Liên lạc 1-866-610-0655 để biết thêm chi tiết.
Is adding chicken broth to dog food actually dangerous?
So Rob, what do you feed your dogs?
You know, I used to think that I was making my dog's kibble extra special by giving them a little added warm water. Here you go, buddy. Fancy you upgrade. But I found out it is a huge mistake.
What? Why?
Well, first of all, you gotta know most kibble is only about 10% moisture. That's the same as raw pasta. Yeah, before your dog can even digest it, their body has to break it down. So it has to pull water from somewhere else, their skin, even their joints.
Joints?
Yeah, and apparently dehydration can stress major organs, like their kidneys and their liver, even if they're drinking plenty of water.
What? That's scary.
Especially because dogs are.
What emerges from this deliberate practice is more than just a technical system. It's a trading philosophy that aligns with market realities rather than fighting against them. As your personal framework evolves, you'll likely discover that your best trades aren't necessarily those with the largest percentage gains, but those where you executed your plan with perfect discipline. This brings us to the true legacy of Jesse Livermore. While history often celebrates his spectacular market calls and enormous profits, his most enduring contribution wasn't about making money, it was about preserving capital through systematic risk management. Livermore understood that spectacular gains mean nothing if they're eventually surrendered through poor discipline. The game of speculation isn't all mathematics or set rules, Livermore famously observed. It's self-control, personal discipline and judgment. This profound insight reveals the journey that awaits beyond mere technical knowledge. By mastering his 5 stop-loss rules, you gain far more than just protection from catastrophic losses. You develop the psychological foundation that separates professional traders from perpetual amateurs. Think of these principles not as mere techniques, but as gateways to a deeper relationship with the markets. Each rule addresses a specific psychological vulnerability that undermines trading performance. The temptation to average down, the impatience with time-based development, the reluctance to trail stops effectively. If you're committed to implementing a structured stop-loss framework in your trading, comment "Discipline creates freedom" below. As we bring our exploration of Jesse Livermore's stop-loss methodology to a close, I'm curious, which of these 5 rules resonated most deeply with you? Was it his unwavering stance against averaging down, his pivot point approach, or perhaps his sophisticated volume analysis? The journey we've taken together through Livermore's principles isn't just about historical trading wisdom. It's about transforming your relationship with risk and cultivating the psychological discipline that defines market masters. These lessons have survived for nearly a century, not because they're complex or mysterious, but because they address the timeless challenges all traders face. If you found value in these insights, consider becoming part of our community by subscribing. Each week we delve into these hidden dimensions of trading psychology and technical mastery that separate consistent professionals from struggling amateurs. The path to trading transformation is one best walked together, learning from both historical wisdom and each other's experiences. I'd love to know you made it all the way through this deep dive into Livermore's methodology. Drop a comment saying, "Market wisdom endures," so I can personally thank you for joining me on this journey. And if these insights have sparked something valuable for your trading approach, that like button is the simplest way to help other traders discover these principles. Speaking of trading psychology, I've created a companion video exploring Livermore's 3 psychological rules for entering trades with maximum conviction. It builds perfectly on the stop-loss foundation we've established today. Click right here, and let's continue exploring how these century-old insights can transform your modern trading results. Until next time, trade with structure, manage risk with discipline, and let the market reveal its intentions rather than imposing your expectations upon it.
Welcome to Better Vantage by Vanguard, a podcast.
Here's the brutal truth that will save or destroy your trading account. 90% of retail traders lose money, not because they lack indicators, but because they're watching the wrong signals entirely, while amateurs chase predictions and hope for the best. Professionals like Jesse Livermore, who made $100 million in 1929, while others jumped from windows, never predicted anything. They simply observed 3 specific indicators and let the market tell them what to do. The fundamental difference between amateurs and professionals isn't intelligence or capital, it's identity. Amateurs ask, what will happen? Professionals ask, what is happening right now? This distinction made Livermore one of the greatest speculators in history, while his contemporaries went broke trying to outsmart the tape. Picture this scenario that destroys accounts daily. You see a breakout on your favorite stock. Volume looks decent. You buy with $5,000, half your account because you're confident. 2 days later, it's underwater. You widen your stop loss because it just needs more room. The stock sinks further. That's not bad luck, that's amateur behavior. A professional would have risked 1% of their account, waited for proper confirmation, and cut the loss fast when the tape spoke differently. While you lost $2,200 chasing hope, the professional lost $100 following discipline. This difference compounds into the chasm between consistent profits and devastating account destruction. But here's what most educators won't tell you. The problem isn't your strategy or indicators. The problem is you're trying to predict what the market will do, instead of observing what it's actually doing right now. Every amateur falls into this prediction trap. They study fundamentals, patterns, and reports, building a crystal ball for tomorrow's prices. Meanwhile, professionals ignore predictions entirely and focus on one question. What is the market telling me through its behavior at this exact moment? Every price movement represents real money, changing hands between real people, making decisions based on real emotions. Fear and greed haven't changed since markets began. The psychological patterns that drove speculation in Livermore's era drive speculation today. Livermore understood something most traders never learn. The market reveals everything through 3 simple indicators that require no complex formulas, no expensive software, no mathematical calculations. These signals existed when traders watched ticker tape, and they exist now in our digital age. The technology changed, but human nature and therefore market behavior remained identical. The first indicator alone will transform how you read price action within 30 days. You'll stop seeing random movements and start recognizing the conversation between supply and demand. The second will teach you when to press your advantage with surgical precision, turning small wins into substantial profits while keeping risk minimal. The third will save you from devastating losses that destroy trading careers. Together, they form what Livermore called the market's true language. Here's your first hard rule. Size from the stop, not your feelings. If the distance to your stop is $1.20 and your risk per trade is $100, you buy 83 shares, not about 100. Precision prevents regret. Second rule.
If you have like problems balancing your blood sugar or insulin, so this can help enhance your insulin sensitivity and
Never widen the stop after entry. You can tighten it with fresh information, but never give the market more rope. Third rule. 1 signal is noise, 2 are interesting, 3 mean business. The tape, the pivotal point, and the market tide must align before you risk real money. When they don't, bank your greatest edge patience. Counterintuitive truth. Doing nothing is often the best trade. Waiting is a position. Frequently, your most profitable one. But here's the catch that separates the 10% who succeed from the 90% who fail. Knowing these indicators is worthless without the discipline to act on them consistently, especially when emotions scream otherwise. Every amateur learns rules. Few develop the character to follow them when money is on the line. The market will test your discipline repeatedly. It will offer seemingly perfect setups that violate your rules. It will tempt you to risk more when winning. It will whisper, "This time is different." When you should cut losses, the tape whispers before it shouts. By the time most traders recognize what's happening, the major move is over. But professionals hear those whispers clearly. They see subtle signs that precede major movements. They position accordingly, with proper risk management, and let the market do the heavy lifting. This is about being smarter or having better information. Success comes from developing the ability to observe without predicting, react without hoping, and cut losses without ego. These 3 indicators will show you exactly how to develop that ability, but only if you commit to learning the market's language instead of imposing your predictions on it. The tape whispers its secrets to those who know how to listen. In 60 seconds, you'll learn exactly what to listen for. Livermore's first indicator was the tape, not the meaningless scroll of prices most traders ignore, but the living conversation between supply and demand, written in price and volume. The tape tells you the market's line of least resistance. Your job isn't to argue with it. Your job is to recognize it, then risk small, and align. Most traders think they're reading the tape when they glance at green and red candles, but they're missing the deeper dialogue happening between buyers and sellers. Every transaction represents a decision made by someone with real money at stake. When you learn to read this conversation correctly, you stop guessing about market direction and start observing what's actually happening in real time. Here's the problem amateurs face. They see rising prices and assume strength. They chase breakouts without reading the character behind the move. A stock can rise on desperate short covering, retail excitement, or algorithmic noise, none of which represents sustainable demand. Professionals wait for what Livermore called repeated character, sustained evidence of genuine institutional interest, not retail excitement. This character reveals itself through volume patterns that most traders completely ignore. When smart money accumulates a position, they do it quietly over weeks or months. When retail gets excited, they do it loudly over hours or days. The tape records both behaviors differently if you know what to look for. Let me share a story from 1907 that cost amateur traders fortunes and made Livermore millions. Railroad stocks were breaking to new highs.
Second time break right there.
The newspapers were bullish, the fundamentals looked strong, and the price action appeared perfect cleanup trend. Higher highs, higher lows. Technical analysis suggested continued strength, but Livermore noticed something the crowd missed. Volume was decreasing as prices rose. While everyone celebrated new highs, the professionals were quietly distributing shares to enthusiastic amateurs. The smart money was selling into strength, not buying it. Within weeks, those railroad stocks collapsed, wiping out traders who focused only on price direction. Livermore had shorted the breakout because the tape told him the real story: distribution masquerading as accumulation. He saw the whispers of weakness long before they became a roar. This pattern repeats endlessly across all markets and time frames. Rising prices on declining volume signal that demand is weakening, not strengthening. Falling prices on declining volume suggest selling pressure is exhausting itself. But amateur traders see only the price movement and miss the volume context entirely. They buy breakouts without checking if anyone of substance is actually buying. They panic sell bottoms without noticing that pressure is diminishing. Here's your protocol for reading the tape correctly. First signal, structure. Look for higher highs and higher lows over several weeks, not just a few days. True trends develop slowly and persistently. Amateur trends spike quickly and die fast. Professional accumulation builds methodically over time, creating a staircase pattern of steady progress. Second signal, sponsorship. Volume should expand on up days and contract on pullbacks. This tells you that institutions are buying strength and retail is selling weakness, exactly what you want to see. When volume patterns reverse light volume on advances, heavy volume on declines, the tape is warning you that smart money is heading for the exit. Third signal, preparation. Range contraction before expansion creates what Livermore called the coiled spring effect. After weeks of sideways action on declining volumes, the stock builds energy for its next major move. This isn't random consolidation, it's professional accumulation disguised as boredom. When the spring finally uncoils with massive volume, the move tends to be swift and substantial. But here's the key. It must be a coiled spring, not a messy stampede. Clean, tight ranges on light volume suggest control. Sloppy, wide ranges on erratic volume suggest confusion. Your execution rules must be precise and non-negotiable. Risk per trade, 0.5 to 1% of equity maximum.
Your business is crushing it, but unless they've got the right help desk software. Oh man, this is my ticket to stop. Your agents can get caught in a whirlpool of tickets.
Come on, break this one.
It's time to save your support with Zohodesk, the ultimate customer service platform. Zohodesk is here to help.
Come on, break it. Look good.
Service, so your customers can troubleshoot easy to fix issues. Many channels, one ticket stream, so you can ride the wave of customer success. Wow, that was such a breeze. Look at that. You just created an ocean of happy customers. Get Zohodesk to make customer service a day at the beach.
So I'm helping me get my money right to achieve my ambitions. Want to see?
Alright, save some here.
Earning more money on my money as a head chef. Ready for service? And saving to give back to local producers. So if I can help fund any ambition you're hungry to achieve, like investing in everyone's dinner table. Bank with SoFi to earn a higher APY and an epic 12%.
This one collapsing right here.
Get your money
Need to
back.
get out.
Write 1% max on your monitor where you'll see it every day. This isn't a suggestion, it's survival.
Look here.
Entry timing.
Right here, touch
Buy
it,
after
see?
range contraction. On the expansion day that closes near highs with 150 to 200% of average volume.
Save some here and save some here already.
Sponsorship, not just retail enthusiasm. Stop loss placement, just below the contraction floor or prior day's low, whichever is tighter. This gives the trade room to work while limiting damage if you're wrong. Position size calculation. Determine shares from risk to stop distance, never from conviction. If your stop is 2 away, and you're risking 500, 500, you buy 250 shares, regardless of how sure you feel. With a 20,000 account and 1% risk, your loss budget is 200,200. If the stop is 1, 0,
You crazy guy, bucket.
1, 0 away, you buy 200 shares. Precision protects you. Sloppiness invites regret and needless drawdown. Emotion has no place in position sizing. Conviction kills accounts when it overrides risk management. Pattern interrupt. No expansion after contraction means no trade. period. If the spring doesn't uncoil with authority, step aside and wait for the next setup. Waiting is a position often your most
I
prone.
show some here.
Amateur traders feel compelled to trade every setup they identify. Professionals trade only the setups that meet all criteria with room to spare. The difference
Right
between
here.
approaches determines who survives and who doesn't.
This is a good one. INTS, get in 72.
Volume patterns.
Sell at 80, right here, 82.
Where do you draw the line?
74.
Hesitation from commitment. That's the pivotal point. Livermore's second.
CM, get in 621. Get out right here.
Or resistance level drawn by
Six,
technical analysts.
right here, look at
Lines
6,
on charts. It's a
68 and
psychological
660.
battlefield where the market declares its true intention.
Good. Already 688 right there.
Traders, each carrying emotional baggage from previous encounters with that exact price level. Livermore watched for these moments of announcement, then acted decisively with defined risk parameters.
This one right here, sell some.
Certain prices
Where is
carry
it?
more psychological weight than others' prices, where fortunes were made and lost, where dreams died and hopes were born. These aren't random numbers on your screen. They're emotional landmarks burned into the memory of everyone who ever owned the stock at those levels. The amateur's fatal mistake is buying near resistance or before the breakout. They anticipate the pivot and get chopped up by false signals, head fakes, and stop runs designed to shake out weak hands before the real move begins. They see a stock approaching a previous high and immediately start planning their entry. Convinced they've spotted an obvious opportunity that everyone else missed, but markets don't reward the obvious, they reward patience and precision. Professionals let the stock prove itself above a clear level, on undeniable
Look at it, dumb already, huh? Crazy. You need to learn how to sell,
They
okay?
never anticipate, they always confirm. This
Learn how to sell.
approach separates those who consistently profit from market inefficiencies from those who become the inefficiency that others profit from. Here's a perfect example from Livermore's own trading that illustrates the psychological dynamics at work. Union Pacific had fallen from 180 to 120 inches, 1,907, creating massive emotional trauma for thousands of holders who watched 6060 per share evaporate from their accounts. Many sold at the bottom in despair, swearing off stocks forever. Others held on, hoping for recovery, praying to break even someday. When Union Pacific later rallied back toward 140, amateur traders assumed it would continue higher after all. It was recovering from oversold conditions. The fundamentals were improving. The selling had exhausted itself, and momentum...
Right, this like look like collapsing.
Looked bullish on the surface. But Livermore recognized 140 as a pivotal point where thousands of trapped investors would desperately sell to break even. These weren't professional traders with disciplined stop losses. These were emotional investors who had suffered through months of sleepless nights, watching their life savings lose 1/3 of its value. Now, finally, they had a chance to escape with smaller losses. The psychological pressure to sell at 140 would be enormous. Every holder who bought between 140 and 180 would be thinking the same thing. If I can just get back to 140, I'll sell and never touch this stock again. Livermore shorted Union Pacific at 139, just below that critical psychological barrier, and within days it collapsed back to 110 as trapped holders flooded the market.
YYEI collapsing.
He predicted.
I was surprised when a waiter smelled like Creed Aventus while I smelled like... So I asked him how he was able to avoid...
Right here, double top, bottom right here.
He gave me this. Apparently there's something called micro perfume, and it's the smartest thing I've ever seen.
The buyer deep right now.
Designer fragrances into smaller ones, making them affordable to anyone. So this $365 Creed Aventus bottle was actually just $7.99. I instantly ordered a bunch of them, and now I can smell better than ever. You can too. Just press the link and order yours.
See, right here, resistant, guys. It took resistant, never see it again. That's crazy.
Hey traders, awesome to see you all here, and thanks for joining. Just an important announcment, this stream is delayed. If you want to get access to the live features, so the live stream, the live commentary, access to our private Discord room chat, then use the link that we have in the description just under this video, guys. And also, I would like to ask you all kindly to hit the like button, subscribe to the channel if you haven't done that already. And again, I'll see you guys out there. Thank you.
The professional sees a stock approaching old highs and thinks, trapped trader exit point. The amateur sees the same level and thinks, breakout opportunity. This psychological understanding separates the consistent winners from consistent losers over time. Markets aren't just mathematical constructs, they're psychological ecosystems where human emotions create predictable patterns of behavior. Fear and greed haven't changed since markets began. The same psychological forces that drove speculation in Livermore's era drive speculation today. Your protocol for identifying and trading pivotal points must be systematic and unemotional. Identification requires a minimum of 6 weeks of consolidation or a clear prior major high that created significant emotional impact. Quick, shallow pullbacks don't create the psychological conditions necessary for a true pivotal point. The level itself equals the highest closing price within the base. Adjusted for obvious stop hunts, where market makers briefly spike the price to trigger stops before reversing. Don't use intraday highs. Closing prices reflect where serious money was willing to hold overnight. Confirmation requires a close above the pivot level with 150 to 300% of the 20-day average volume. This ensures the breakout has genuine institutional sponsorship, not just retail enthusiasm or algorithmic noise. Execution timing is critical and non-negotiable. Enter on the close above the pivot or on the first constructive pullback that holds above the pivot level on lighter volumes. This pullback tests the new support and shakes out weak hands who bought the initial breakout. If the stock holds the pivot level on declining volume, it demonstrates that selling pressure is exhausted and buying interest remains strong. Stop loss placement goes 3 to 5% below the pivot or below the breakout day low, whichever is tighter. This gives the trade room to work while limiting damage if the breakout fails. Position sizing must risk only 0.5 to 1% of equity to the stop distance. No exceptions regardless of conviction level. Here's a modern example to anchor these rules. A leading software stock builds a 7-week base between 4646 and 5151. The highest close is 50, 8050, 80, and volume dries up by 40% over the last 4 sessions, creating the coiled spring effect. On Monday, it surges through 51, 0, 0, 5, 1, 0, and closes at 51, 7, 0, 5, 1, 70 on 220% of its 20-day average volume. Professional execution. Buy the close at 51, 7, 0, 5, 1, 70. Set the stop at 49, 9, 0, 4, 9, 9, 0, 3.5% below the pivot. Calculate position size based on the 1,801, 80 risk per share. With a 25,000 account, risking 1%, 250, you buy 3 white shares, 2 cent bot traveling 1.12, 3 white 1, 3 white, 2 cent right, 1.12, 1, 1.12, 1.12, buy at 50, 50, 50 on Friday because it will break Monday, risking 2,000, 500, 2,000, 500 because you feel confident. Pyramid. As position.
They're dumb right now.
Specific conditions. Add only 2033.
So try to dump this one.
Size, and only after the stock has moved +1R to +2R in your favor. Using our software example, if the stock advances to 53, 5053, 501, 801, 80, profit equals +1R, you can consider adding 46 shares, 33% of 138, but only if price forms a tight flag pattern and breaks higher on fresh 1.5x volume expansion. Never add to hope or to average down. Only add to proof of continued strength with institutional participation. Two maxims should guide every pivotal point decision. Pay the toll at the pivotal point, and add to proof, and not to hope. The first reminds you that quality setups require patience and precise execution. You can't get professional results with amateur timing. The second prevents the deadly mistake of averaging down or adding to positions that aren't working. The market rewards strength and punishes weakness. Your position sizing should reflect this reality, but even perfect pivots, confirmed by strong volume and clear price action.
Build better habits so you can outperform yesterday. Choose better to be better with personalized coaching on the new book.
Hey friends, Eric here, and in this video I want to talk to you about how you can retire with just $300,000. Most people can retire with $100,000 a year of income. If you use a traditional finance retirement calculator, and you will need a portfolio of approximately $1 to $2 million. And the math works out to be
can fail when swimming against a strong tide. Individual stock strength means nothing if the broader market is distributing or sector leadership is failing. A perfect breakout in a weak market is like a strong swimmer in a rip current. The technique is admirable, but the outcome is grim. The final indicator separates the professional from the gambler market confirmation, and the specific times you should cut position size in half before you even click buy. Livermore never fought the general market because he understood a fundamental truth that separates professionals from amateurs. Individual stocks, no matter how perfect their setups, will drown when swimming against the broader tide. When the market showed distribution patterns, he immediately cut risk across all positions. When it confirmed strength with expanding volume and healthy leadership, he pressed his advantage with surgical precision. This sounds simple, but it's brutal in execution because it demands constant vigilance and the discipline to act against natural impulses. When you've identified what appears to be a perfect individual setup, the market's primary trend acts like an invisible current. It can carry even mediocre stocks higher during bull markets, or drag the strongest companies lower during bear markets. Fighting this current is like sailing directly into a hurricane because your compass points toward treasure on the other side. The amateur's fatal flaw is isolating stock analysis from market environment entirely. They develop tunnel vision, focusing intensely on their favorite setups while ignoring the broader context that will ultimately determine success or failure. They spot a perfect fit.
Everything go up and go down.
With ideal volume characteristics and compelling tape action.
Right here, see? I get out all right here.
Miss that major indices are showing distribution days. Sector leaders are rolling over, and market breadth is narrowing dangerously.
VWAP.
The tape reading in their individual stock.
Everything on the VWAP, right?
But they still lose money because
right here, the
tide
VWAP
that lifts all boats has reversed into an undertow that drowns even strong swimmers. Picture this scenario that destroys accounts daily. You identify a textbook pivotal point at 50-50 inches, a leading semiconductor stock that's been building a tight 7-week.
Look at down right now.
Entry timing is perfect.
Fake break down, fake break out.
3-0, 5-0, 30 on 180% of average volume, closing strong at 50. 8-5, 5-0, 85. Every individual indicator screams buy. And your execution follows professional protocols. But here's what you missed while focusing on your perfect setup. The S&P 500 has logged 5 distribution days in 3 weeks, indicating institutional money is quietly heading for exits. 2 leading semiconductor stocks just broke decisively below their 50-day movement.
Just like this, look at here.
Your stock initially cooperates, moving to 51, 2-0, 5, 1, 20. Validating your analysis and making you feel like a market wizard. Then, reality hits with devastating force. The broader market weakness finally reaches your stock.
See,
collapses to 40.
I get it right here.
0.
Somewhere right here where?
8. 20 within a week.
10 o'clock?
Loss. The individual
get it right here.
Wrong. Your stock did have legitimate source.
Break. Fake break out, pull back.
Was ignored. In context, always wins.
Fake break out.
This is why Livermore said,
dumb right here, sell right here.
And I never argue with the market.
And here's 6.
Both must align for maximum probability.
And the last one right here, get out under the VWAP, get out more.
And quantifiable. Removing
Take some profit. Make about 40 cents.
Distribution day monitoring forms your early warning system. Count distribution days in a rolling 4-week window. Defining a distribution day as any session where a major index is 0.2% or more on volume higher than the previous session. This indicates institutions are selling into strength, quietly distributing shares to retail buyers who remain optimistic. When you count 4 to 6 distribution days in 4 weeks, adopt a defensive posture immediately. This doesn't mean panic selling, but it does mean reducing position sizes, tightening stops, and avoiding new purchases until conditions improve. Second, leadership assessment provides your sector health filter. Identify the top 3 to 5 stocks in each major sector and monitor whether they're making higher highs with expanding volume. These leaders typically move first in both directions, providing early warnings for broader moves. When sector leaders start lagging indices or breaking below key moving averages like the 50-day, reduce position sizes by 50% across all holdings in that sector. Leadership failure often precedes broader weakness by several weeks, giving disciplined traders time to adjust before major damage occurs. Third, trend confirmation requires monitoring whether major indices remain above both their 50-day and 200-day moving averages, with constructive volume patterns on advancing days. When indices trade key moving averages or show declining volume on up days, institutional participation is weak. Without institutional buying, rallies become unsustainable and vulnerable to sudden reversals. Your position size governor must adjust automatically based on these market conditions, removing discretion and emotion from critical decisions. Use full position sizes only when the market uptrend is confirmed. Sector leaders are strong and making new highs, and distribution days are minimal. This represents ideal conditions where individual stock strength aligns with market strength.
My honest review on this natural remedy book after having it for a month. Look at this blood sugar page.
Creating maximum probability for successful trade. Reduce to half position sizes during mixed conditions where some distribution is present, but the overall trend remains intact. Cut position sizes to 0 during heavy distribution clusters when sector leaders are failing, or when broad market weakness is evident. This isn't market timing, it's risk management based on observable evidence. Markets provide endless opportunities, but capital is finite and must be protected. 2 maxims should guide your market confirmation decisions: swim with the tide or stay on the sand, and the best trades align individual strength with market strength. The first reminds you that fighting the market's primary trend is a losing proposition over time. The second emphasizes that extraordinary profits come from finding individual stocks with strong technical setups during favorable market conditions. You now possess all 3 indicators that form the foundation of Livermore's legendary success. But knowledge without integration is worthless intellectual exercise. Next, we'll fuse these 3 indicators into one complete system, your daily routine for reading markets with the same precision that made Livermore one of history's greatest speculators. Information doesn't change, accounts routines do. Here's how to thread all 3 indicators into one disciplined system that transforms theoretical knowledge into consistent profits through daily practice and unwavering execution discipline. Livermore never acted on single signals because he understood that markets are complex systems where multiple forces interact simultaneously. He waited for confirmation from at least 2 indicators, preferably all.
I saw this one go new high all day. Look at this one.
This patience separated him from impulsive amateurs who jumped on every individual signal that appeared promising, only to discover that one piece of evidence rarely tells the complete story. Professional traders developed the discipline to wait for what Livermore called a confluence of evidence, multiple indicators singing the same song before committing money to the trade. Let me show you the complete system in action through one of history's most famous trades.
If this one breaks 7, you're $8.
929, just before the great crash that destroyed millions of accounts and changed American finance forever. Livermore was watching Anaconda, which had rallied to a pivotal point around 130, a level where it had previously met heavy selling pressure from trapped holders trying to escape at break-even prices. That was indicator 1, suggesting extreme caution. as psychological resistance at old highs often proves insurmountable when broader conditions deteriorate. Next, while Anaconda made new highs and newspaper headlines celebrated the advance, volume was declining with each successive rally day. Smart institutional money was quietly distributing shares to enthusiastic retail buyers who believed the new era of permanent prosperity. Propaganda, that was indicator two, confirming his growing suspicion that this strength was artificial and unsustainable. Finally, the general market was showing unmistakable signs of exhaustion, distribution days clustering across major indices, leadership rotating from growth stocks to defensive issues, and market breadth narrowing despite rising headline numbers. All three indicators told the same story. This uptrend was living on borrowed time and would collapse once retail enthusiasm exhausted itself. Livermore shorted Anaconda at 128.128, just below the critical psychological resistance level. Within weeks, it collapsed to 7070, while others celebrated the new era and averaged down into oblivion. His success came not from predicting the crash, but from recognizing that all three indicators aligned to suggest unsustainable conditions. Your daily integration protocol must become as automatic as breathing, requiring no more than 5 minutes each morning to assess market conditions and position yourself accordingly. Begin with morning market assessment by counting distribution days in the past 4 weeks across major indices. 4 to 6 distribution days signals defensive posture, more than 6 demands standing aside entirely. Check whether the top 3 to 5 sector leaders in technology, healthcare, financials, and consumer discretionary are making higher highs on expanding volume. Leadership strength indicates institutional participation. Leadership failure warns of broader weakness ahead. Note each major index's position relative to its 50-day and 200-day moving averages, as these levels often act as magnets during uncertain periods. This quick scan provides your market context filter, determining your overall risk posture for the day. Watch list management requires maintaining 10 to 15 stocks forming 6-week or longer bases near pivotal points, with volume patterns showing the telltale 40-60% dry up over 3 to 5 days that precedes major moves. Set price alerts at pivotal levels but never anticipate breakouts. Always wait for confirmation through closes above resistance on expanding volume. Track each candidate's structure, sponsorship, and preparation in your trading journal. Evidence first, action second. You are a responder to market signals, not a predictor of future moves. Your execution checklist must be ironclad and non-negotiable. Risk per trade stays between 0.5 to 1% of equity maximum. Write this prominently on your monitor, where you'll see it before every trade. Entry triggers require either a close through the pivot with 1.5 to 3x normal volume, or the first low volume that holds above the breakout level. Stock placement goes 3 to 5% below the pivot or below the breakout day low, whichever provides tighter risk control. Position sizing must always calculate from stop distance, never from conviction level. If your account is 50,000, and you're risking 1%, 500,500, and the stop is 2, 502, 50 away. You buy exactly 200 shares. 500 divided by 2.5 equals 200. 500 divided by 2.5 equals 200. Conviction doesn't change arithmetic. If you can't size it precisely, you can't trade it safely.
I want to know, have you made this mistake with your holster? And by mistake, I mean, did you get a holster that's uncomfortable so you don't carry all the time? You may have. And even if you haven't, you probably want a holster that's more comfortable. Enter the Vanish holster, the world's most comfortable holster. And guess what? Today, it's buy one, get one free on these. That's right. We're not going to run this special forever, but if you grab one right now, you'll get one of these already at a discount, and then you'll get the second one 100% free. Why would you want this holster? You know, it's a great question. And the reason is, it's comfortable. Like I said, we have built it with premium materials like this yellow paint material in the belt that is supportive and stretchy, so you can wear it all day long without even noticing it's there. It doesn't get stinky, slimy, or sweaty, or anything like that. The front, made out of 1000D Cordura. Same material used in a lot of military applications because of its durability and its stretchiness. And then this on the back is a nice microfiber. It does the same thing as the belt. It just doesn't get nasty, practically vanishes on your body when you're wearing it all day long. Now this belt works with anybody of any size, so it doesn't matter how big or small you are, the Vanish holster is going to float your boat. On top of that, it works with all of your guns, 99% of them to be exact. carries two
Pyramiding, adding to winning positions, demands extreme discipline in specific conditions that most traders violate through greed or impatience. Add only 33% of your initial position size, and only after the stock has advanced +1R to +2R in your favor, proving the initial thesis correct through price action. Using our example above, if the stock advances to 502, 50 your initial risk amount, in stat, you can consider adding 65 shares, 33% of 200, but only if price forms a tight flag or secondary pivot with fresh 1.5x volume expansion. Never pyramid after a market distribution day, as broad weakness can quickly reverse individual strength. Never average down under any single rule of behavior account more than any other. Your risk management governors must adjust position sizing automatically based on indicator alignment, removing emotion and discretion from critical decisions. Deploy full position sizes only when all three indicators align perfectly, tape showing accumulation, pivotal point confirmed with volume, and market environment supported. Reduce to half position sizes during mixed conditions where some distribution is present but overall trends remain intact. Cut position sizes to 0 during heavy distribution periods or when sector leadership is failing broadly. These aren't suggestions, they're survival protocols that preserve capital during inevitable adverse periods. 3 maxims should guide your daily practice. Cut losses fast, size smart, cut noise always. Add.
So I created this indicator which gives me buy and sell signals for any chart. Take a look at this.
Have you ever watched your trading account slowly bleed out, wondering why the markets seem to punish your every move? What if I told you that most traders fail not because they lack intelligence, but because they're asking themselves the wrong questions before hitting that buy or sell button? But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already...
Alright, this one collapsed already, so watch out this one right here.
Bell so you don't miss any of our future videos. The brutal truth about trading is this. The markets don't care about your hopes, your dreams, or your carefully constructed theories. They move according to their own rhythm, their own logic, a complex balance of supply and demand that rewards only those who can see reality clearly, without the distortion of emotion or wishful thinking. Has this ever happened to you? You enter a trade based on a good feeling, or perhaps a hot tip from someone who seemed knowledgeable. The position immediately moves against you, but instead of accepting the reality in front of you, you double down, convinced the market will eventually prove you right. Days or weeks later, you finally exit with a devastating loss that could have been a minor setback. Jesse Livermore, perhaps the greatest trader who ever lived, understood this psychological battlefield better than anyone. Through brutal market lessons, some costing him literal fortunes, he discovered that successful trading isn't about being clever or predictive. It's about discipline and clarity. It's about seeing the market for what it is, not what you wish it to be. Stay with me until the end, because what you're about to discover might completely transform your approach to the markets. Livermore distilled his decades of trading wisdom into 3 golden questions, 3 simple yet profound checks that separate the professionals who build wealth steadily from the amateurs who get crushed by market forces they never saw coming. These questions aren't complicated formulas or sophisticated technical indicators. They're straightforward inquiries that force you to confront reality before putting your hard-earned money at risk. They're the survival tools that protect you from your own worst impulses, the impulsiveness, the overconfidence, the denial that ruins more trading accounts than bear markets ever could. What fascinates me is how often traders overlook these fundamental principles. They spend countless hours analyzing charts, studying economic reports, and back-testing strategies. Yet they ignore the most critical component of all, their own psychology, the way they react when the market moves against them, the size of the positions they take relative to their capital, the clarity with which they assess trends. Imagine having a framework that cuts through the noise and emotion of trading, a mental checklist that keeps you grounded when others are being swept away by fear or greed. That's exactly what Livermore's 3 golden questions provide. They're not just theory, they're battle-tested principles that kept one of history's most successful speculators alive through crashes, panics, and boom cycles. The market is always testing you, probing for weaknesses in your discipline. It's searching for the moment when you'll break your own rules, when you'll let emotions override your judgment, and when that happens, the market will punish you without mercy. That's why the first of Livermore's golden questions cuts straight to the heart of what matters. Is the trend clear? If you're serious about mastering your trading psychology and want more insights like these, hit that subscribe button now. I'm dedicated to sharing the timeless wisdom that has kept professional traders alive through bull and bear markets alike. This question might seem deceptively simple, but it represents a profound mindset transformation for most traders. Before you risk a single dollar, you must be able to identify, without any mental gymnastics, whether prices are moving up, down, or sideways. The hidden truth is that many traders enter positions without ever answering this fundamental question. They buy a stock because it looks cheap, or because some guru recommended it, completely ignoring the actual direction of the market. But here's the revelation that changed Livermore's journey forever. The market doesn't move because you think something is undervalued. It moves because of the relentless forces of supply and demand. No amount of wishing, hoping, or intellectual justification can overcome these forces. The tape, as traders call it, doesn't lie. It doesn't have emotions. It simply reflects the collective decisions of all market participants. If you can't clearly see which way the river is flowing, why would you jump in? You might as well be trading blindfolded. Yet every day, thousands of traders place bets without this basic clarity, setting themselves up for unnecessary pain. They mistake noise for signal, random fluctuations for meaningful movement. The impact of this mistake compounds over time, slowly eroding both capital and confidence. Once you've honestly answered the first question and confirmed that yes, the trend is indeed clear, you move to Livermore's second golden question: am I ready to lose? Notice he doesn't ask, how much will I make? This priority shift is critical to understanding the professional trader's mindset. While amateurs obsess over potential profits, professionals focus relentlessly on risk. Before you enter any position, you must decide exactly how much you're willing to lose if you're wrong. Not if you might be wrong, when you're wrong. Because in trading, being wrong isn't an accident or a failure. It's an inevitable part of the process. The market will prove you wrong regularly. What matters isn't how. Often you're right, but how you respond when you're wrong. This is where most traders' journeys go off track. They enter trades with vague hopes for profits, but no concrete plan for losses.
Why did Amazon send me $20,000? Because I use Amazon AI. I'm going to show you a way to potentially make money by pairing Amazon with the power of AI without ever selling physical products. And I promise you've never heard about this before.
Why is Amazon paying me $63,000 a month? Well, they make this kind of money selling yoga mats and toasters, and I damn sure wasn't talking to my friends into buying vitamins and juices. I did it with a free app that's probably already on your phone, and that app is the Kindle app.
I just created some simple digital products, then I put them up on Amazon, and it was so exciting. The first time I tried it, I made $14, and I was like, oh my goodness, this actually works. Hi, I'm Carla Marie, and the coolest part is Amazon puts over 300 million customers just a click away. So age, experience, qualifications, none of it matters. I want to share my full system with you, but obviously this is an ad, so I'm hosting a free workshop where I walk you through my system step by step. This system's transformed my life, and it's sprinkled a little magic in the lives of hundreds of other people.
Now, I hate workshops that are so slow and boring that they send you to sleep, so I made sure that this workshop moves fast and that it's fun, exciting, and informative. That said, if you love face-to-face selling, don't click on this ad. You see, with this, you never need to talk to anyone or push products on people. So this definitely isn't a good fit for someone with a salesy personality type. However, if you want to learn a low-key way to potentially make some extra money working from home that can cover some important bills and help you enjoy more fun trips, don't wait. Click anywhere around this video and watch the free workshop now. Discover how we create reliable streams of semi-passive income without complex websites, unneeded stress, or huge startup costs. You'll even get 3 valuable bonuses just for watching. We've designed these bonuses to help you succeed with this as fast as possible. I can promise this training will be free forever, so watch it now. Could this be the stepping stone you need to start living the kind of life you've only dreamed of? There's only one way to find out. So click now, watch the training, claim your bonuses. You'll be glad you did. I'll see you on the other side.
When we rediscover our place in nature, we remember its place in us. It's time we let nature's wonder back into our lives.
Then, when the market moves against them, they freeze. They can't bring themselves to exit. They start bargaining, telling themselves, it'll come back. These 3 words, it'll come back, have destroyed more trading accounts than any bear market in history. The professional's approach is radically different. Before the trade is even placed, they've already accepted the potential loss as a cost of doing business. They've drawn their line in the sand. If the market reaches that point, they exit without hesitation, without emotion, without second guessing. It's this willingness to take small losses quickly that allows them to survive long enough to catch the big winners. Now, I want to go even deeper into this topic by exploring how these first 2 questions connect to something even more fundamental to trading success, your relationship with your capital. Because even with a clear trend and a predetermined risk level, there's a 3rd element that determines whether you'll survive to trade another day. Write in the comments. Clarity before action, if you've ever struggled with cutting losses quickly. This brings us to Livermore's 3rd and perhaps most overlooked golden question. Is this trade in harmony with my capital? This question reveals a profound truth that many traders discover too late in their journey, that even the most brilliant market analysis becomes meaningless if your position sizing is wrong. Behind the scenes of almost every trading blow-up is the same story. Not a failure of market analysis, but a failure of capital management. A trader spots a clear trend, sets a reasonable stop loss, then sabotages everything by betting too much on a single idea. The psychology behind this mistake is fascinating. It's not just greed, but often a misplaced confidence that comes after a string of winning trades. The revelation that transformed Livermore's approach was simple yet powerful. Your trading size must be in proportion to your account. The market doesn't care how certain you feel about a trade or how compelling your analysis looks. When you bet too heavily, you're playing a dangerous game where a single mistake can erase weeks or even months of careful work. Think of your trading capital as oxygen underwater. Each breath must be measured, each movement calculated. Waste your air supply with one deep impulsive gulp, and you won't make it back to the surface. The blueprint for survival is methodical conservation, taking only what you need when you need it. What's most striking about this principle is how it creates a cascade effect on your decision making. When your position size is appropriate for your capital, something remarkable happens. You can think clearly. You can allow the trade to breathe. You're not fixated on every tick Every minor movement against you, your emotional landscape transforms from panic to patience. Conversely, when you're oversized, your mindset deteriorates rapidly. Every small move feels magnified. Your time frame compresses. Suddenly, you're making decisions based not on your analysis or your plan, but on fear. And fear is the costliest consultant you'll ever hire in the markets. These three questions about trend clarity, loss acceptance, and capital harmony aren't just trading rules. They represent a complete mindset transformation, a fundamental shift in how you relate to the market. They aren't principles to follow occasionally when convenient. They must become deeply ingrained habits, as automatic as breathing. This is where Livermore's wisdom transcends trading and touches on something universal about human nature. The hardest battles we fight aren't against external forces, but against our own impulses. The market offers endless opportunities. Finding them isn't the challenge. Disciplining ourselves to trade them correctly is. The hidden truth that separates sustainable success from fleeting luck is this: wealth in trading doesn't come from a magical indicator or a secret formula. It doesn't come from predicting the future or outsmarting other market participants. It comes from building the right habits, asking the right questions, and maintaining the right mental posture day after day, trade after trade. Ready to transform your trading journey? Subscribe to the channel for more powerful insights that go beyond theory and into the practical psychology of consistent profits. Join thousands of traders who've already elevated their market approach.
These 100% grass-fed beef sticks from Paleo Valley are 36 for just $36 right now. But before you go and buy them, here are 5 reasons I replaced processed snacks with these. Number 1, the ingredients. There's 100% grass-fed beef from American Family Farms and organic spices, which makes these sticks incredibly flavorful while keeping things clean. Number 2, they're naturally fermented, which creates a great flavor, but without the preservatives like encapsulated lactic or citric acid found in all the other meat sticks. Number 3, they're perfect for when you're trying to cut back on processed carb-heavy snacks, but still want something satisfying and delicious. Number 4, they're super convenient. I keep them in my bag, the pantry, my desk drawer, and I send them off to school with my kiddo. They're a great protein-rich snack that won't hinder my health goals. And number 5, they're from Paleo Valley, which means everything is well-sourced, 100% grass-fed, grain-free, gluten-free, soy-free, 0 grams of refined sugar, and absolutely no seed oils. Like I said, they're 36 for $36 right now, so go and check them out.
Whether you have money or not, I recommend you buy this. This telescopic clothes rack was a gift from my brother-in-law. It can be installed easily without drilling. It extends freely to adjust the length. Mounted on the bedroom wall, it fits perfectly. Hanging washed clothes on it is very convenient. It has excellent load-bearing capacity. Can even handle winter quilts without any problem. When not in use, it can be disassembled for storage. The key point is that at this price, shipping is free. Isn't it basically like getting it for free? The link is right here. I expect it will sell out soon.
Damn, how come I didn't find this thing sooner? It fixed my huge headache with drying clothes at home. Super easy to install, just pull and snap it into place. For everyday washed clothes, just hang them up. Keeps things cleaner and more hygienic. And it holds weight like a champ. Even our bed sheets dry on it, no sweat. Super convenient. And the best part? It's 50% off right now, plus free shipping if you order today. Stock's running low. Grab it before it's gone.
And this leads us to perhaps the most counterintuitive aspect of trading psychology, the relationship between discipline and freedom. When these 3 questions become second nature, something unexpected happens. Instead of feeling constrained by rules, you experience a profound sense of liberation. Drop a comment with "discipline equals freedom" if you've realized that proper position sizing is your trading edge. This liberation comes precisely because you've learned to recognize and manage the greatest threat to your trading success: your emotions. The market is a psychological battlefield where fortunes are won or lost not based on intelligence, but on emotional resilience. Every day, the market tests your nerve in ways that reveal your deepest vulnerabilities. Have you ever watched a stock run up without you, feeling that burning sensation of envy, that whispered thought that you're missing out? That's the market testing you. And when you finally give in to that feeling, jumping in late, isn't that often the precise moment when the trend reverses? This pattern reveals a profound truth about the psychology of markets. They move in ways that maximize emotional pain for the unprepared. The transformation that occurs when you internalize Livermore's golden questions is that they become a shield against these emotional assaults. They create a decision framework that exists outside your feelings, a set of objective criteria that protect you from the worst enemy you'll ever face in the markets: yourself. Trading isn't about outsmarting other market participants. It's about outsmarting your own weaknesses, your impatience, your greed, your need for validation, your fear of missing out. The market will always be bigger, faster, and more powerful than any individual trader. But you can control yourself, and that's where the real battlefield lies. One of the most powerful revelations from Livermore's journey is understanding that ego doesn't build wealth, it destroys it. How many times have you held onto a losing position, not because your analysis supported it, but because you couldn't bear to admit you were wrong? That's ego trading your account. And ego is the most expensive consultant you'll ever hire. The market itself, what traders call the tape, has no emotions. It doesn't feel remorse for taking your money. It doesn't celebrate when you profit. It simply reflects the collective actions of all participants, moving with indifferent precision. Only you bring emotions to the equation. And this is where the cost of fighting the tape becomes devastatingly clear. Many trading fortunes are lost, not because traders couldn't identify market direction, but because they couldn't control their position size or their patience. They let small losses grow into account-destroying disasters. They cut winning trades short out of fear. They violated their own carefully constructed rules because of excitement, panic, or simple stubbornness. The mindset shift required here is subtle but profound. Instead of seeing the market as an adversary to be conquered, see it as a force of nature to be respected and aligned with. You wouldn't stand on the beach trying to push back the tide with your hands. Why would you fight a clearly established market? Trend with your limited capital. Behind every successful trader's journey is this fundamental acceptance. The tape is never wrong. When it moves against your position, it's incorrect or irrational or manipulated. It's simply showing you reality. And reality doesn't care about your opinions or your cost basis or your financial needs. This brings us to a deeper understanding of how these emotional battles play out in real trading scenarios. Consider what happens in your mind when you watch a position move against you. The sequence of thoughts and feelings that unfold reveals everything about your relationship with the market. Type emotional mastery in the comments if you've ever held a losing trade too long because you couldn't admit you were wrong. First comes denial. This is just a temporary pullback. Then bargaining. If it just gets back to break even, I'll exit. Then anger. This market is rigged. And finally, for those who refuse to cut losses, comes despair. I've lost everything. This emotional sequence destroys trading accounts daily because most traders never formalize their decision-making process. This reveals another powerful insight from Livermore's journey.
Everything to get your brand in front of your face, like t-shirts, water bottles, and totes. So everyone can gift it, work in it, and take it. Whether it's one of a kind or one for your whole team, if you need it, we print it with 20% off for new customers at vistaprint.com.
This sweater? New? No. I've washed it 30 times with Brazil. The color's too vibrant for LA. That's right. It's vibrant wash after wash. Clothes look newer for longer with Brazil.
A written rule is 10 times stronger than a spoken one. When the market starts running, and your blood rushes with adrenaline, memory gets fuzzy, intentions blur, promises to yourself evaporate in the heat of the moment. The breakthrough that can transform your trading reality is astonishingly simple yet rarely implemented. Write down your rules.
Look at Japan.
Put them where you can see them. Make them physically present in your trading environment. This isn't just about
Get down
mental,
right here.
It's about accountability.
Sit down,
Your
guy.
rules stare back at you from a page or screen. They pull
Look
you back to the
collapsing.
emotional
Japan.
edge. They remind you of the cost of breaking discipline. What's remarkable is how universal this principle is. Even traders with decades of experience who've made and lost fortunes never outgrow the need for these fundamental questions. Livermore himself, after years of spectacular success, would still ask before every trade, what's the trend? What's my risk? Is this size right for my capital? The moment you think you've graduated beyond these basics is precisely when the market will humble you most severely. This brings us back to the cornerstone of all trading success, determining the trend. It's the foundation everything else is built upon, yet it's where so many traders stumble. The average trader is impatient. They see prices moving and feel compelled to participate immediately. But what are they really acting upon? Is it a clear signal of direction or merely the noise of the tape? The revelation that changed Livermore's destiny was recognizing how much of market movement is meaningless noise. False starts, minor rallies, shallow dips, movements that signify nothing in the larger pattern. If you mistake these for real direction, you'll find yourself whipped in and out of trades until both your capital and confidence are shattered. Think of trend as the heartbeat of the market, the river's current, and you, as a trader, are simply a boat on that river. You can row, you can steer, but you cannot fight the current. If you try, you'll exhaust yourself and sink. The wisdom that separates the successful from the failed is understanding that it's safer and more reliable to align yourself with the dominant trend than to think you can call the turn. This isn't just theory, it's practical psychology. When you trade with the trend, you're swimming with the tide rather than against it. You have momentum on your side. You don't need to be perfect in your timing because the general drift carries you toward profit. But when you fight the trend, you need to be precisely right, and the market rarely rewards such precision consistently. The mindset shift required here is profound. Instead of seeing yourself as a market predictor, see yourself as a market follower, someone who observes and aligns rather than forecasts and fights. This shift from prediction to alignment represents a complete identity transformation for most traders. Comment, I follow, not fight, if you've realized the power of trading with the trend instead of trying to predict reversals. This transformation isn't easy because it challenges one of our most basic desires, to be right in a special way, to see what others can't see. Many beginners are attracted to trading precisely because they believe they can outsmart the market, predicting exact tops and bottoms that no one else catches. This romantic notion of being the lone genius who calls the perfect reversal is seductive, but ultimately destructive. Imagine for a moment standing on a train track, watching a locomotive barreling toward you at full speed. Would you try to stop it with your bare hands because you think it's gone far enough? That's exactly what happens when traders sell short in a roaring bull market, simply because they believe prices have risen too much. The market doesn't care about your opinion on what's too much. It cares only about supply and demand. The revelation that transformed Livermore's journey was accepting that the tape, the price action itself, sees more than any individual trader ever could. The tape is the collective wisdom of every market participant, the sum of all available information expressed through price. To stand against it is to believe that your limited perspective somehow trumps the combined knowledge of the entire market. What's fascinating is the paradox.
Some good news.
The clearer the trend,
Envy too.
Cleverness.
Oh man, maybe some COVID.
In a world where complexity is often equated with sophistication, This is a profound insight.
Oh, and me, all right here, moving right there.
Theories and complex indicators.
Some COVID report or something.
With real money. Meanwhile, the trader who simply aligns with the obvious flow keeps their account intact.
Năm 2026, Activa có một chương trình bảo hiểm với tổng phúc lợi lên đến 2.880.
This principle extends beyond the technical aspects of trading into a deeper philosophy about truth and perception. In markets, price movement itself is the ultimate truth.
It's a nice ball plot right here.
Not forecasts, not theories. If prices move higher day after day, that's not a random occurrence. It reveals genuine demand. If prices sink lower consistently, that's not bad luck. It shows real supply. Your job as a trader isn't to argue with this reality, but to recognize and align with it. The liberation that comes from this understanding is powerful. Instead of fighting the market's natural movements, you learn to flow with them. Instead of trying to prove how smart you are, you focus on how profitable you can be. This shift from ego to results, from prediction to observation, marks the true beginning of a successful trading journey. Behind the scenes of every great trader's development is this moment of surrender, not giving up, but giving in to what the market is clearly showing. It's the recognition that certainty doesn't come from complex analysis or insider knowledge, but from the clear signals the market provides freely to anyone willing to see them without bias. Hope, on the other hand, is the most expensive emotion in trading. When a trade is based on hope rather than observable reality, it's no longer trading, it's gambling. And the house always wins eventually. The path to consistent profitability isn't paved with hopes and wishes, but with clear-eyed assessment of what is actually happening in the market right now. This brings us to a crucial aspect of trend identification that's rarely discussed: the courage to do nothing when no trend is clear. Most traders feel compelled to always be in the market, always making moves. But sometimes the most profitable position is cash. Comment: patience is profitable. If you've ever felt the pressure to trade when no clear trend was present. When you truly understand the rhythm of markets, you'll come to a profound realization that forever changes your trading journey. Every single trade carries the possibility of loss. This isn't pessimism, it's reality. And embracing this reality is what separates professional traders from perpetual amateurs. Most traders have their priorities backward. They obsess over potential gains, dreaming about how much they might make, while giving little thought to how much they might lose. This fundamental misalignment creates a dangerous blind spot in their decision-making framework. The market doesn't reward dreams, it rewards preparation. The battlefield metaphor is particularly apt here. Even the most meticulously planned military operations can fail due to unexpected resistance, weather changes, or communication breakdowns. Similarly, even your best trading setups can collapse in seconds due to breaking news, sudden shifts in market sentiment, or large institutional sellers entering the market at precisely the wrong time. The revelation that transforms trading psychology is accepting this uncertainty as a feature of the system, not a bug. Once you understand that losses aren't failures, but an inevitable part of the process, your entire approach shifts. You stop taking them personally. You stop viewing them as evidence of your inadequacy. Instead, you see them as simply the cost of doing business in the markets. This mindset transformation unlocks a powerful truth. Preparation for loss is actually the foundation of profitable trading. By defining exactly what you're willing to lose before entering a position, you create a decision framework that protects you when you're most vulnerable. When a trade is moving against you and emotions are running high. The hidden wisdom in Livermore's approach was deciding exit points in cold blood, not in the heat of battle. When you're watching your position deteriorate in real time, your judgment is compromised. Fear clouds analysis. Hope replaces objectivity. That's precisely the wrong moment to be making critical decisions about whether to hold or fold. Instead, the disciplined trader makes these decisions before entering the trade, when their mind is clear and emotions are stable. They draw their line in the sand. If the price reaches this level, I'm out, no questions asked. And then they honor that commitment regardless of how they feel when that moment arrives. This pre-commitment strategy doesn't just protect your capital, it protects your psychological.
Critical mineral shortages are threatening G7 nations. Limited smelting capacity is leaving Western supply chains vulnerable to nickel processing controlled by Russia and China. Even if the US and EU were to dig more minerals out of the ground, many of these minerals would need to be shipped overseas for concentrating, refining, and smelting. But now First Atlantic Nickel has made a groundbreaking discovery of an ultra-rare nickel alloy that could be the largest in the Atlantic in over 30 years. Alloyrite, a naturally occurring magnetic nickel-iron-cobalt alloy, contains up to 77% pure nickel, and the First Atlantic Nickel discovery spans a massive 30-kilometer-long belt. This game-changing alloy can be processed domestically using simple magnetic separation techniques.
Alright, I'm done, guys. See you guys later.
Well-being. A loss is simply tuition, the fee you pay to stay in the game. And when you know your risk and accept it in advance, something remarkable happens. You trade without fear. Think about the freedom this creates. When you've already accepted the worst-case scenario, you're no longer controlled by the fear of it happening. You've made peace with the possibility. This clarity of mind allows you to focus on executing your plan rather than second-guessing it. Your decisions become sharp.